Hello again, everybody, and welcome to this next episode on navigating the world of alternative finance, non-bank finance. My name is Kevin Pierce. I am the president and CEO of Caldez Financial. You can find me on the web at www.caldezfinancial.com. This is the second in our 13-part series on navigating the thorny world of alternative finance. Thanks for joining me. In our last episode, we gave a brief overview of what I call the four main criteria in helping to determine who your next lender is going to be. Those criteria are industry, collateral, performance, and size. And today we're going to take a deeper dive into the concept of industry. Okay, we've been looking at a few industries. Let's dig into real estate a little bit. There's investment real estate, there's owner-occupied real estate, and there's development. Investment real estate could mean commercial investment real estate or consumer investment real estate. If you're a real estate investor, you may own office buildings. Those would be commercial leases. You could have retail strip malls. Those would be commercial leases. But in the case of a multifamily apartment project, for instance, the investor is a commercial enterprise, but the end user is a consumer. You look at things like occupancy rates, tenant durations, net operating income, and things like that. These are the types of things that lenders look at. They also look at the appraised value of the property. So in terms of the appraised value, usually there's loan to value requirements. In a bank situation, it's not unusual to see 75% or 80% loan to values against an appraisal. But in turnaround situations, it's a little more difficult to get that high. And that sort of works against the interest of the borrower. But that is the reality. Another typical example of an owner-occupied property could be a restaurant. If the restaurant owner owns the real estate, then that's probably the one biggest piece of collateral they have. That's an owner-occupied piece of real estate. Or maybe a hotel. Hotels are generally classified as owner-occupied real estate transactions. All right, and a third sort of subset of real estate lending is real estate development lending. These are very specialized types of loans. They require a very specialized type of expertise to look into, and they look at things like the internal rate of return on the property, the demographic, the surveys, and kind of what was the original rationale for the existence of this development in the first place, and so they have to buy into that concept and understand the timing of the construction period and then the sell-off period and ultimately how they get paid back. So let's talk about another industry. Financial services isn't one that is talked about in terms of debt financing, but the fact of the matter is most lenders have some form of financing, either in the form of a warehouse line or, in the case of banks, deposits. And typically there has to be transparency in the portfolio, because the lender that is providing a warehouse line to another lender will have certain rules and certain restrictions on who they can lend to and what circumstances they can lend to, and certain rules about covenants and things like that. So this is, again, a very specialized form of lending that requires this very specialized skill set and expertise. All right, another industry that I think everybody knows pretty well is retail. Most people, when they think of retail, they think of consumer retail, places that we go to shop. These businesses are financed by specialty finance groups all the time. It's based on the liquidation channels. And some goods, some specialty goods like, if you were to take a store like Spencer's, where you have very specialized type of inventory, or another one would be Sharper Image. This is very specialized type of inventory. It is likely that the advance rate would be lower on this kind of stuff because there aren't as common inventory liquidation channels as there are with, say, clothing, soft goods, shoes, socks, and things like that. All right, finally, let's touch on something that's fairly new in the scheme of things, and this is another industry that's come around in the last 30 to 50 years, and that is technology. I think when you look at technology businesses, you can look at hardware and software, but I'll just basically boil it down to a few different stages of technology companies. You have early stage software companies, and the first stage is usually friends and family money, some equity coming in. And then you get to a mid-stage software company where you may do a Series A funding, This is coming in the form of equity or convertible debt. So when you're talking about software companies, sometimes software companies will be successful in launching their product and they become revenue positive. A lot of times these revenues are in the form of recurring monthly revenues, or RMR. These recurring monthly revenues are considered by some lenders to be collateral, and they actually you can construct a borrowing base based on these recurring revenues. So let's wrap this up. We've been talking about various industries, and let me just put a few summary thoughts out there. Number one, every industry has various sub-industries, and the sub-industries are very widely differentiated and need different technical skills and different lender profiles in order to be talking to the right lenders. Another thought, and this is kind of relevant in today's society where we have new products that are constantly coming up. Some of these are more difficult than others. Technology is a little farther along than cannabis, but cannabis is kind of a rising star in terms of its future potential for attracting debt. A lot of lenders, especially bank lenders, but even non-bank lenders that are publicly traded or whatever, will have difficulty doing cannabis deals because of the sort of incomplete landscape of the regulatory environment. And my final thought with regard to industry is that every now and then there are certain industries that just fall out of favor with lenders as a whole. Right now, and for the past couple of years, oil and gas has been very difficult to get financed. There are another one that's fallen out of favor since COVID has been hotels, because obviously occupancy rates are down and therefore sales are down, and bars and restaurants have been under extreme pressure during COVID. It's been a little easier for those deemed restaurants than those deemed bars. The point being that bars and restaurants are not a very favored industry right now, and so it's very difficult to get financing, and what financing is available out there is going to be pretty expensive. Obviously cannabis, as I just mentioned, is probably on the rise, but we're not there yet. Very few lenders are lending to cannabis companies, and in fact banks in a lot of cases won't even lend to companies that do business with cannabis companies. So if you have a strip mall and one of your customers is a dispensary, it might be very difficult for you to get bank financing to finance the whole strip mall, even though most of the strip mall has nothing to do with cannabis. All right, well, let's summarize our thoughts with respect to industry and how they can affect the lender that ultimately will provide you your next loan. We've talked about industrial businesses, hospitality, we've talked about healthcare and real estate, and we've talked about financial services and retail. And I think what we've learned today is that all of these industries have sub-industries that are very unique, and this is one of the reasons I'm trying to illustrate why it's so difficult to just go out there and find a loan for your business, because your business is so unique from other businesses in other industries and even from other businesses in your own industry. So again, thank you for watching. I'm glad that you joined me on episode 2 of how to navigate through the wild world of alternative finance. My name is Kevin Pierce. I'm the president and CEO of Caldez Financial. Please visit me on the web at www.caldezfinancial.com. And if you have any feedback for me, I'd love to hear from you. You can reach me at kevin.pierce, P-E-A-R-C-E, at caldezfinancial.com. I hope to hear from you, and I hope to see you again in another episode next week.